advanced market structure. So I hope no one gets intimidated by the content that we did in the previous video and think that maybe since it's now advanced, it's even more difficult. No, there's only one new concept that we'll be talking about in this video, or in this part of the session, and that concept is called anticipation. Right? The concept is called anticipation. So what are we simply trying to do? We are trying to make sure that let me use this one. Right. So what we're trying to do by looking at advanced market structure is to use our understanding of basic market structure in terms of higher highs, higher lows, and how those relate to internal or minor structure to anticipate changes in the move of the market. So we'll start with a very simple example, which is we have a market that's trending up, right? And obviously this is our higher low and our higher high, and price comes up to break our higher high, which gives us a bullish breakout structure scenario, right? Remember that this low over here is only labeled a higher low and it's a swing low when it breaks this high. But by the time it breaks this high, I'm sure you can agree with me, we've missed a significant portion of the move. Obviously, this is very subjective for the scenario, but we've missed this entire move up, and we only see that this is valid as a breakout structure at this point, which is it's very dangerous to start looking for buys here. It's not that it's a bad thing and it's not possible to make money with by looking for buys after the breakout structure. No, it doesn't necessarily mean that's an impossibility, but there are a number of things that can cause you to lose money here. Number one is whenever we experience a breakout structure and you see price pushing up like this, there's now a higher probability that we could see a pullback happen on that particular time frame. That's the first thing. The second thing is also we've got breakout traders who are waiting for this high to be broken. As soon as this high is broken, a number of breakout traders start placing buys to enjoy the move upwards. And when those breakout traders start to do that, because of their anticipation by placing pending orders, there's a lot of buy side liquidity, or for lack of a better term, let's just say there's a lot of liquidity that is resting above this high, right? People who believe price is going to be pushed up. So sometimes before the move continues, it generates more liquidity to go up by pulling down, stopping out everybody who had buy stop orders here, and then continuing up. How far this pullback goes is obviously something that's up for debate depending on the scenario, but I'm sure you get the point. So instead of trying to buy further up in the move, we want to try and catch the move as it starts in and around these regions or somewhere early on down here, so that by the time price reaches this point, we are already exiting the trade. All right, that's essentially what we want to do. So where anticipation comes in is that we are trying to catch this trend as it changes from being bearish to being bullish, and we want to anticipate the change as it happens, take a cue from the market by means of market structure, and join the move as it goes in terms of internal structure for a higher time frame external structure move. Okay, I hope that's clear enough. So that's why we want to talk about advanced market structure today. So let's sort of go through the model that we've been looking at in previous videos, right? Which is something like this. Let's draw it together and label it together. So obviously we've got price moving from a low over here, gives us a high, higher low, higher high, higher low, higher high, and so on and so forth. So let's label that white, and let's just put some text to indicate that this is our H4, which is the white line, and we also want to have an H1 line here, which indicates our internal structure, right? So let's label this. This is our higher low, and we've got two higher lows over here, and we've obviously got the higher highs over here. I'm just doing this so that make sure that we're on the same page and we understood the same thing, right? And then we've got the internal structure, which obviously pushes up impulsively according to our sort of utopian example, right? And then we get a sort of correction over there, right? And we've got a strong impulse which moves like that. Let's make that blue since this is our internal. So we're just using H1 and H4 for purposes of the example. It doesn't mean you have to religiously stick to these time frames for whatever reason, but I'm just using those as a way to illustrate and put our point across. Okay, so this is what we have in terms of our internal structure. And if we were to label our internal structure, we can all agree that at this point we've got a lower high and we've got a lower low. Let's label this in blue, and then we've got our lower lows coming in over there in blue again, right? So these are our internal lower lows and our internal lower highs. Now, where does anticipation come in? What we sort of want to do is to capture, again, like I said, we want to capture the move as it changes over here from being bearish to being bullish, right? We want to capture the move as it changes from being bearish to being bullish. Excuse me. So what are we going to do? We're going to watch as price creates the higher time frame higher low, right? And we wait for a shift in direction of the internal market structure from creating lower highs and lower lows to starting to create higher highs and higher lows, right? So let's label that higher high in blue, and we also want to see higher lows. And in this exact example, this is what we see over here. We see a higher high and we see a higher low, and we also see price doing the same thing over there. And this is exactly what we want to do. We want to catch it as it begins to show internally that it's shifting to being bullish, and then we catch an entry somewhere within this pink circle and we move with price as it goes on to break the previous highs. Okay, so far I believe we're still together, because this is basically mostly these are the concepts that we covered in the previous video. So let's take a closer look at the pattern of what's taking place over here, right? So what you have is you have price coming down like this, creating a low, and then shifting, create a high and moving up, right? And let me do it this way, right? This is essentially what we're seeing if we magnify this part, all right? So we've already labeled that this is a lower high. So the first concept that we want to introduce is when price breaks from this lower high, when price breaks this lower high actually, and moves up to create this higher high, there's a name for this. We call this a bullish change of character, right? So why do you call it a bullish change of character? We call it that simply because price has changed from a bearish character where it was making these lower highs over here that were labeled to starting to create higher highs, right? So the first sign that we see that price is now making a high, which is a break of this previous high, which would have been a swing point because it broke the previous low to come over here and create a lower low, right? We expect this to be protected as long as the trend is still bearish. But once we start to see a shift like this and we see this violated, then we know there's a possibility that a bearish trend is starting, a bullish trend is starting. The bullish trend is only confirmed as long as this low over here is not broken, right? So if this low is not broken, then we know that price has created a higher low when it breaks this high again. I hope we're still together. So every time price is coming in, it's creating lower highs and lower lows, right? From wherever it was coming from, price was creating lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. And then when it creates this low here, at a point where we are anticipating this change to happen, the change comes in, we see a bullish change of character to indicate to us that the market might be shifting its structure, it might be changing its character. Then we anticipate price to create a higher low. When price creates this higher low, we find an entry somewhere in here and we move with price upwards. And if we manage to catch this higher low over here, we are in for the higher time frame, or H4 in this case, H4 trend. And now we'll be able to either exit here, or if we have reason to believe price will continue, we'll continue to hold. I hope that's clear cut for everybody, right? And then if we look at a scenario where we try to trade against the trend, we would be looking over here, right? Now, obviously, trading against the trend is not something that we want to do. In terms of our strategy, we always try to trade the higher time frame trend, and in our case, that's the H4. If we see the H4 moving bullish, creating higher highs and higher lows, we'd prefer to look for buys, all right? Which means we're looking for points that are in and around here, where the higher time frame may create a higher low, and then we hold towards the previous high. But there will be scenarios where, because this is an H4 time frame, we don't have to necessarily wait for price to come down and miss the entire action. However, that is risky because number one, you never know how far price is going to move down. It might just move a little bit and stop you out and continue. You're fighting the trend, obviously. And then there's also risk that because it might be a corrective move down, you may realize it may stop you out a number of times because price is too choppy and take you out of the move. You're right about the direction, but the price is just too choppy and it's moving correctively down, and you get stopped out of your position. So what we want to see when we look at the scenario where we are trading against the trend, right? We obviously want to see the very same thing. We want to see price coming up, creating higher highs and higher lows, creating a high, changing its character by breaking the previous higher low, failing to create a higher high, and then price sort of continuing. This is what we want to see when we look over here. And let's just label that. This obviously becomes our change of character. Why? Because we're the previous higher low and we're the creation of a higher high, and then the higher low was violated. This was obviously a swing point because it broke the previous high high, and we would have expected that as long as price is bullish, this previous low would have held strong. But obviously it was weak in that this high managed to create a lower low. So as long as this high is not violated, it will be confirmation to us that price may be moving lower, all right? Which is exactly what happens. Price fails to break this higher high, comes in, creates a higher low, okay? And for us at this point, we're obviously looking to take shorts and move with price down towards whichever area we are trying to look for buys, okay? So in this scenario, we're simply taking shorts so that we're able to buy. So the question then becomes, what's the difference between the change of character and the break of structure? Now, the change of character is simply the first sign that we might be seeing a change of character. It's the first sign. And the first sign is normally a break of, say in this scenario where price was moving, creating lower highs and lower lows, we'll see price breaking a significant lower high. And when price breaks this significant lower high like this, then there's reason for us to start to question whether the trend is still valid. Yes, price may continue to move down, in which case if it breaks this low, we know that it's still bearish and there was other internal structure that was still being broken. But if we're in the right areas where we had already anticipated this to take place, then when we see it happen, there is a significant probability that price is going to create only a higher low before pushing up. By the time it breaks this high again, it is now confirmed to us that price has changed. Why? Because we now have a higher high and a higher low. By the time it breaks this part, that's when we can call that a break of structure. All right. So this is the difference that's between a change of character and a break of structure. A change of character is normally just the first sign that we see of a possible or potential character change. But only market structure can then confirm itself when price is continuing up. And by the time it makes a break for the second time, then we can be assured that the internal structure has shifted bullish. And this is now a bullish break of structure, all right? And the trend is probably changed. And the same is true for this side as well. Without wasting too much time, obviously, when we see this pot break, what should we call that? It's a bearish break of structure. Okay. So let's talk a little bit about this thing called the change of character, right? Let's talk a little bit about this change of character. There's some rules we need to observe if we're going to be trading the change of character successfully, right? So the first rule we need is every change of character must, let me first write this way, ChoCh rules, right? One, it must take place at a significant zone of supply or demand, or let's just put in brackets, area of value, right? So what do we mean by this? Let's wrap that. What do we mean by this? What we simply mean is that every time, we can't say every time we see a change of character, we automatically assume the trend is changing. Because remember, let me just give you an example of a 15-minute chart in this correction over here. Or maybe let's say actually, yeah, let's use a 15-minute chart. So price is moving up, and when price gets here, over here, we start to see that shift, and we may see price do this and then push up. Let's put that in green, right? Why is this significantly important? Question is, why is this significantly important to see? Let me just make adjustments to make sure it's clearer for all of us to understand why this is important, right? So what you can see here is price comes up, creates a high, comes in, creates a low, creates a lower high, creates another low, violates this high, or let me make it clearer because that's what I want for the sake of this example, right? Come on, man. Right, so it violates this high, continues lower, and because you have seen this violation, you begin to anticipate that there's a buying opportunity that lies somewhere here, and for whatever reason you start to look for buys, but the order flow is still bearish. This entire section, the order flow will still be bearish in as much as you're still you're looking for buys. And that's the risk that comes with trying to look for change of characters everywhere. You need to have a significant zone where you say it must line up with where the change of character is taking place. Now, if you do not understand that, let's illustrate it on our example over there. Let's clear up all this nonsense so that the chart doesn't become too dirty. Okay, so if we look at this change of character over here, what we're simply saying is, if we look left, we need to have a zone where this is taking place. All of this. Whether this zone is a strong support area, whether this is a strong demand area, whatever you want to call it, it must be an area where you're expecting price to shift, or where price could possibly shift from, for one reason or another, from being bearish to bullish. And this zone, it must be a higher time frame zone. Let's put it in there. It's a significant higher time frame zone, right? So it must be higher time frame than the zone, than the internal zone or internal structure zone time frame. It must be higher time frame than the internal structure time frame. So if, for instance, we are seeing the H1 shifting bullish, it must be reacting to, say, an H4 zone of demand or an H4 support. When we begin to see that happen, that's when we know that this zone has got enough power for buyers to come in and cause a change of character in the bullish direction. And then because it's a higher time frame zone, it's more dependable, it's highly likely to hold and create the higher low that we're looking for and push price up. Okay, so these things, I want to warn you, they take place anywhere and everywhere in a market. You can't be taking every change of character that you see. Let's go to rule number 2. Rule number 2 is it must be impulsive. Right, so we're still looking at a bullish scenario. What we mean by saying the change of character must be impulsive is this move up it must show you that the buyers are committed enough to push price further up. If it's a very corrective change of character, what are the chances that the buyers are struggling to push the price up? According to our nature's theory, those chances are high. It's highly likely that if buyers are just coming in and it's taking a while for price to push up and you see a change of character, it's highly likely that when the sellers step in, they're going to step in with an impulsive move, stop you out if you had found whatever looked like a buying opportunity there, and then you take a loss. So because you're sort of going against the trend, you want to see that the buyers are stepping in with a lot of force. And we've already discussed how to determine if this is an impulsive move in relation to this counter trend move. And you'll see it when price hits your higher time frame point of interest. You want to see this price shifting up, and you know that there's a high probability that the buyers are going to keep holding the market, and the market will shift in direction. Okay, remember, we are simply trying to anticipate, so we're looking for the earliest signs that give us the probability of winning and going with the market as it shifts as it shifts from one direction to the other. And then the last thing that we obviously want is we want it must be clear on the internal market structure, right? So you can't have a change of character that doesn't look clean. I mean, you know how it is in the market. The market is not perfect. Sometimes it's gonna come down in a very, very weird way, and it's not going to give you the textbook look that you're looking for. Okay? And then what you're gonna do is, because you're seeing something that you don't understand and you're wondering what's taking place over there, you may end up trying to look at it from a higher time frame, look at it from a lower time frame, whatever. Maybe you go to the 1 minutes, yet so desperate for a trade. But when you go, say, to your H1, you cannot see this break of structure clearly. It's not clear. But because you're desperate to go for the buys, you simply say, oh, okay, you know what, I'm happy. You work on a trade and you decide to go with the market long. You're simply going to create a problem for yourself. What you're simply going to do is create a problem for yourself. Rather, if you can't see that change of market structure or change of character on the internal structure clearly, let it go. Just let it go. Leave the trade. Other trades will come. More trades will form. Clearer trades will meet your trading plan. This is extremely important because you're trading against a trend. Remember, the internal market structure is fighting you because it's going lower. And you are trying to buy because you're trying to anticipate a higher time frame change of trend. So because you're fighting the trend in both scenarios, you need to have very good rules that allow you to come right when you execute. Okay, so these are the three most important rules that I think are important to observe when you are trading the change of character. Okay, and then let's talk a little bit more about the multiple time frame model that we're looking for. Okay, how does this all sort of tie in? And I just want to try and help you to understand this in a context of the time frames that we trade. So let's say we have the H4, right? We want to see a pullback and we want to see price go up. So let me just label it like this. Say this is the H4. Make sure that's green for purposes of this example. Text wrap. Okay, right. So obviously, let's say this zone that we've drawn here is our demand zone, and we're expecting price to come back into an area of demand, which is exactly what happens, and push up. This is what we're expecting, and then we want to see price break our structure, and we want to be able to take profit when price reaches the high. This is happening on the H4. What do you want to see? You want to see an internal change of character. So price was pushing up, right? And then we obviously had a push down. Like that. And we see price move up like this. So this is obviously taking place on a H1 time frame. Let's label it like so. right? So this is taking place on an H1 time frame, and let me just create more space over there, right? And again, we said we want to see this bullish breakout structure over there, right? Now on the H1, because we're trying to anticipate a trend change over there, it means we have to look over here to see that pattern which we've been talking about. This is the schematic that we're looking for in terms of market structure on the H1. Why is it important for us to see this? Is because before we can start to think that the H4 time frame is bullish, something has to confirm to us, give us early warning signs that the trend is changing. All right. So we can't just work on a buy at this point over here, because then price could just may well continue lower and stop us out. So we need price to confirm that it's now changing character. And how do we see that? We see price coming in. It's been creating lower highs, lower lows, lower high, lower low, lower high, lower low, and then we see what? Of course, it's a change of character to create a higher high. Then we wait for evidence of a higher low over there, at which point we then take a trade, and then we move with the market further up. Okay, so this is what we're simply looking for. You must remember this is very much a fractal thing. Like I've already said, you do not necessarily need to trade these time frames that I'm giving you here. These are my personal favorite time frames, but you will realize this is going to happen on many other time frames. So another person may prefer to see this on the M15 because they feel that they'll get a later confirmation on the H1. For other people, they prefer this green to be the H1. They wait for an M5 change of character, and when price comes back again to this point, which they're expecting price to let's just do that. When price comes back to this point at which they're expecting it to create a higher low, they go to the M1. They look for another change of character. Okay, let me illustrate that. Maybe, but I'm sure you get it now. They look for another change of character, which is simply price creating low highs, low lows, changing character like this, and they're in. Okay, this is exactly what they would be looking for on an M1. So they want to see this here taking place over there. Once they see that, they're happy to take the trade. Okay, so this is sort of the fractal nature of the markets that you need to be looking for. You are not trying to beat the market in any way. You're simply trying to listen to what the market is telling you, and whether the market is telling you that it's going to buy. If you don't see a change of character, it simply means the market is saying it's not going to buy. So it might as well just continue lower, you know. And if you try and fight that, if you try and fight the market and continue to look for buys, the market can be wrong. You know, even if the market were to go wrong, you know, it can be like that longer than you can sustain funding your trading account. So we know that the market is never wrong. The market is always right. So you don't need to try and fight the market. Just look for what the market structure is saying. As long as the market structure continues, it does not respect your demand zone, and it continues to give you a market structure that's bearish, just join the market until you get to the next area where you anticipate the change to take place. All right. So I hope this has been clear. This is what we're looking for. So there's also a scenario where we want to trade against the trend. Now, trading against the trend is about trading this part, right? It's about trading this part over there. So like we've already indicated, what we're simply waiting for is, because we know, and this part, by the way, is the part that we see over there. What we're simply doing is we're selling whilst we're anticipating the buy. And the safe way to see this is before we just start to say every time we see price moving up and trying to move down, we're going to take sales. It might be the retracement. We simply wait for our normal change of character model. All right, price must just be creating higher highs and higher lows, shifting internal structure, and then price moves further down. Okay, it's that simple. We're not trying to complicate it. So obviously we're going to have our change of character here, and we'll also have our breakout structure over here, as we've already shown you. So you need to make sure you're following those rules that we gave for a change of character, meaning if it's going to be, say, in H1, you've got a significant zone of a significant area of value here where price might turn to become bearish. Maybe it's a major resistance, major zone of, I don't know, supply, whatever it is, major order block. As long as it's a significant point of interest where you know price might turn, you anticipate price must turn, and then you get that internal change of character, then that's how you sort of take a trade against the trend, move down with it whilst it heads back to where, to our point of interest where we can continue with the trend and move up. All right. So these setups are exactly what we're looking for. Again, we are not trying to fight the market. When price comes back here, right, say this is the H1, you can move to an even lower time frame, maybe an M5 or whatever. Wait for the same thing. Wait for the same thing. The market will continue to do the same thing over and over, right? Maybe it's your M1 again. You simply go and wait for that, right? This is what you're going to wait for. When you get it, take the risk over there, move with price lower until you reach the point where you believe price is going to turn, or until you see another change of character which shows that price is going to move up. But when you're trading against the trend, one thing that's important to note is you don't want to be holding this position. Personally, I recommend that you have a fixed risk reward ratio, or a fixed, I don't know, maybe it's a fixed amount of money, a fixed number of pips. Traders do it differently, but I recommend that you don't hold, because you're fighting the higher time frame trend. Trend might as well just move here and then stop you out, continue higher. Okay, so these are the two setups that I trade. These are the two setups that I think if you can master, you can simply become a profitable trader in terms of from a strategic point of view. These are the two things that I'm looking for. I'm never looking for more than that. I'm simply looking for price to come into a point of interest, change its character, and I move with price. Price come into a point of interest, change its character, I'm going against the trend. When it hits my TP, I'm out. I'm happy. I'm not even looking to be holding these trades for too long. All right. So let's talk about the break of market structure. The break of market structure. Okay. So let's look for a piece of price action where price is trending. Let me do that. And let's simply look at a scenario of this part. Right. And this part, if this were the only part that we're analyzing, you could be able to tell that price is obviously creating a series of lower highs. Let me just move this up. We've got a lower high here, we've got a low, another lower high, and we've got a lower low, and price moves up over here. We've got another low over here, another high, sorry, and we don't know whether this is going to stand as a swing point until this low is broken, and we don't know whether if price is going to break. We'll see what's going to happen next, but it's critical to notice this. We want to see if we believe price is moving lower. So price has just dived down, given us a lower high, which means it's failed to create a high high. So we want to see price take out this low over there for us to know if price is truly changed its character. Okay, so if we look, let's just look left for a moment and extend this over there. Right, as we can see, price here pushed up, gave us a higher low, pushed up, and we can see the higher low over there, because this is the wick, which was the highest point before we saw a retracement, and then price pushed up higher. The question then becomes, where is the break of structure taking place? Is it taking place when this wick violates the high, or is it taking place when the candle closes, closes above like that? That's the question. In this scenario, so we're going to say bullish break of structure, and in this scenario here, we know that we've already seen a change of character, because let's call that a bear change of character. Why? Because this was the higher low. This was the higher low point. Price came in, created a higher low, pushed up. So when we see this low being broken, we can already say this is a possible change of character. We've got a demand zone over a zone of supply over there, or whatever point of interest, and we anticipate this may hold and price may come in and continue downwards. And that's exactly what we see. Price comes in, continues downwards. Now, where does this bearish break or structure take place? Does it take place when this wick breaks and it pulls back up? Or is it fulfilled only when we see a candle close below? So how we normally do it is, we use both scenarios. If it's a break of structure in the direction of a trend, let's write that down. If it is a break of structure, right, we are normally looking for a candle close. And then if we are looking at a change of character, then we are normally looking for a wick to break below, right? So what do I mean by this? So in this scenario, we had price moving up, it was bullish. Price comes up here, creates a high low. We only consider this a break of structure when this candle over here closes above where the retracement started. When it closes above, that's when we say it's a break of market structure. As long as it's just a wick that breaks above, we're not interested, right? We are not assured that price is certainly moving up. As long as the price has the intention to continue to be bullish, we want to see that momentum in a bullish direction being shown by the candle closing at a higher price. Okay, because for all we know, we might see price come in, give us a sigh, and break down, and then continue to go even lower. Those things do happen, right? And then for the change of character, in this case, we see price closing strongly below. Can you see how many candles this is? Just over here. So many candles, right? So many candles. And then over here, with a strong break to the downside. Now, if this candle had not closed below, we'll still be happy because the number of candles it took to cover all this show that there's enough selling momentum for the trend to change, which is what happens in this case. So even if this candle doesn't close below, it's still fine. Okay, it's still fine. So when it's a change of character, we're happy to look at wicks. But now, because we've already seen that price has now created a lower high over there, and we've already seen a lower low. When price starts to move, because we're looking for a break of structure here now, we don't consider this a break of structure this wick over here. Neither do we consider all these wicks here. We only say price has a broken structure when we see this candle here close below. And that's when we start to look for a retracement and look into some areas where we might see price shifting its structure to continue bearish. Okay, I hope that is clear enough.